topic for this evening's presentation and the purpose really of the Community Foundation is to promote charitable giving in our community. And what we're going to be talking about are tax incentives that will facilitate and maximize the value of your charitable gifts. And here to discuss that with me are my three panelists. I'm Rob Malone from Buckingham Blue and Burles, by the way, and this is Steve Cox from Retz Wine Address, Naomi Dono from CBiz, and Mike Selesnik from, what's the name of the firm?
GDK.
GDK. Thanks, Mike. The classes of real estate we're going to be talking about are real estate, stocks and securities, investment assets, and stock and securities, and life insurance. And by way of background information about private wealth we have in America, we have $37 trillion in bonds. And this information is a little dated, but the information I've got was $37 trillion in bonds in America, $21 trillion in stocks. Retirement accounts are $18 trillion. Real estate is gross $38 trillion. Net of debt is about $25 trillion. And life insurance is $10.5 trillion. So if we could gift all that to the Community Foundation, those are those numbers that John was talking about. Okay, so that's sort of setting the stage. So let's begin with some panel discussion of these types of assets and the nature of those assets for charitable giving. So first question for Naomi is, Naomi, is a retirement account a good asset to give to charity, and if so, why?
Yes, Rob, it is. That is good, that's loud. Retirement assets are easy to give, and they're also the most tax-wise asset to donate to charity. Retirement accounts are one of the largest assets for most Americans. According to the Investment Company Institute, there were more than 6.5 trillion IRAs and more than $20.9 trillion overall in retirement plans in 2013. That's a lot of retirement dollars. There are some tax benefits to giving your retirement asset to charity. The assets, they've not previously been taxed for income tax purposes, and currently the highest federal income tax rate is 39.6%. And your retirement assets can be taxed at 40% in your estate if you pass away with them and you have a taxable estate. If your retirement plan designates charity, like Akron Community Foundation, to receive your retirement account when you pass away, it would avoid the income tax and the estate tax, both federal and state. So for income tax purposes, that's 39.6%. For estate tax purposes, that's 40%, and an effective tax rate for federal purposes of 64%. It's also a great way to leave a legacy by naming Akron Community Foundation as the beneficiary.
Naomi, can you give retirement assets during life, or do you have to wait until death to give those assets to charity?
Well, that's a good question. Right now, we can't
Well, you
answer.
wrote it, Naomi, so.
I know. The reason I can't answer that is it's up to the Congress. So most advisors are anticipating that the legislation will be enacted sometime this year that will permit you to give your IRA or other retirement accounts to charity during your life. In the past, the legislation did allow you to do a lifetime charitable gift directly from your IRA to charity without income taxation. You had to be 70 and a half or older at the time of the donation, and it had to be made directly from your IRA administrator to the charity. The gift had to be outright. So currently it is written in the proposed legislation to renew the direct IRA rollover to charity. But we do have to wait till it is passed before we can act. Some years the legislation has not passed until December. We are hopeful that it will pass, and the sooner the better. The benefits of the direct IRA rollover to charity are that it counts towards your required minimum distribution. This is the amount that you're required to take out of your retirement account by December 31st to avoid paying any penalties. It is also excluded from your gross income, and since the adjusted gross income is what is used to calculate a lot of the taxes in the taxing system, and then you're allowed to give up to $100,000.
So how can you contribute assets from an IRA to charity, Naomi?
So contributing your IRA to charity or the Akron Community Foundation is easy. the ACF and your investment advisor will do all of the simple paperwork. ACF and your investment advisor will handle the simple paperwork. But just remember, you should always consult your advisors before you make these decisions. The retirement assets can be transferred to the Akron Community Foundation at your death by completing a beneficiary designation form that is provided to you by the plan administrator during your life. If you designate your fund at Akron Community Foundation as the beneficiary, the IRA assets are not subject to income tax at your death. And then your favorite causes and charities will be able to benefit for many years. Your estate will also benefit from an estate tax charitable deduction for that gift. If the legislation passes allowing the IRA direct rollover to charity, then your investment advisor will handle all that paperwork for you and make the contribution up to $100,000 to the charity that you request. It really can be that simple.
Okay, thanks, Naomi. Now, that's a lot of technical information. So, Steve, let me ask you a non-technical question for a moment. In the famous bit by Abbott and Costello, what was the name of the player on first base?
I believe it was who?
Who's the player? What was the name of the player on first base?
No, who was it?
No, this is not working out.
Not a good idea.
Yeah. Well, this question, yes, we're still working on the bugs on it, as you can tell. Steve, maybe you can tell us a little about the benefits of donating real estate to charity.
Sure. The real estate has lots of the same benefits as Naomi mentioned for retirement plans or other assets. One characteristic of real estate, though, that is really different from, well, there are a couple of different characteristics that real estate has, but one of them, as you heard Rob mention earlier, is that there's lots of it out there. And there's lots of it both in volume and in value. And I don't remember the dollar figure that Rob gave, but from what I've seen in the surveys and information that I've read, over 30% of the nation's private wealth is in real estate in one form or another. So there's lots of it out there. And you know, it's literally all around us. You know, wherever you go, you're generally on some kind of real estate. So unless you're on the water, I guess, or something. But even then. So there's lots of it. And that makes it awfully tempting, I guess, to use as an asset for charitable contributions. And for lots of people, lots of potential donors, real estate is the most valuable asset they have. You know, people have other investable assets or bank accounts or things, but for many people, real estate's the largest asset in value that they have. So those things make it appealing when looking at assets for charitable contributions. Some other benefits, like I said, similar to the ones that Naomi mentioned, are that if you've owned real estate for over a year and you contribute it to charity, you get a charitable income tax deduction for the full fair market value of the real estate, which is obviously appealing to people who are looking for tax donations or tax deductions. You can also avoid capital gains tax on appreciated real estate. So if you've held the real estate for over a year, or maybe you've held it for a very long time and you bought it for some smaller or lower amount and it's appreciated over time, if you sold the real estate, you pay income tax on the capital gains. If you donate it to charity, you get a tax deduction and you don't have any capital gains tax to pay. So that's beneficial. Then you could also, you'd reduce your estate taxes or probate administration costs, or streamline the administration of your estate by eliminating that asset during your lifetime and contributing it to charity. So all of those things are appealing. And then I think one thing that often applies to real estate, maybe more so than other assets, is that you can donate real estate to charity without, or in many cases, without affecting your cash flow. So if you've got residential real estate or income that's not generating, or real estate that's not generating income, you can contribute that to charity and get the tax deduction, but still have your other assets that can be used to generate income and cash flow to support yourself and maintain your lifestyle.
But Steve, you're right. Real estate is probably the largest asset most people own, and yet the amount of charitable gifts in real estate is not that great. Are there any special problems associated with real estate?
Yes. real estate.
Would you care to elaborate on that
Well,
answer? Otherwise, I've got a long time to go here.
Yes, there are, and I guess one of the aspects that sometimes makes it appealing, also makes it occasionally problematic, is that every piece of real estate is unique. You know, not only obviously by location, but by type of real estate, by the use, by restrictions that may apply to the use of the property, and so on. So lots of factors go into considering whether a real estate is a good asset for use as a charitable contribution. That goes on both sides. You've got issues on the side of the donor, you've got issues on the side of the charity, and lots of things have to be considered. One of the factors that often applies, especially for people who have residential real estate that maybe their largest asset is, they might live in it. You know, so if the donor is actually living in the property during his or her lifetime, that requires special consideration for use in charitable contributions. There could be environmental contamination issues. There could be, again, restrictions on the use of the property, whether they be zoning restrictions or easements or other issues that affect the use of the property. And all of those things affect the value and the marketability of the real estate. Most times charities would prefer to have cash or liquid assets that they can invest and do things with, rather than have real estate as an illiquid asset. So those restrictions or limitations on marketability and value are important to charities. So those things all kind of come into play, and charities really have to evaluate whether or not to accept gifts of real estate on a case-by-case basis.
Well, you've identified some problems, Steve. Are there things that can be done to address those problems? Unless you answer that question, yes. If so, could you elaborate on what they might be?
The answer is yes, and I will elaborate. The best way to go, I think, is to work with the charity during the contribution process. So if the donor and the charity start from the beginning, or at least early on in the process, I think they can identify some of those potential problems and work together to resolve them. Many charities have experience with those kinds of gifts and have a process in place that they will follow. But in general, certain things apply. First off, you need to get an appraisal of the real estate, and the appraisal is important for both sides of that transaction. It's important for the charity so that they know ultimately, if they're going to sell the property, what they might expect to get for it. And then from the donor's side, it's important because they need to substantiate the value of the property for taking the income tax deduction that many times they're looking for. And then in addition to the appraisal, the charity and the donor oftentimes want to engage in what might be called a due diligence process, or kind of an investigative stage, where they look at the real estate, look at issues that might apply to it, to see whether it fits the mold or fits the circumstances and would be a good charitable gift. And as part of that process, there might be a physical inspection of the real estate. Oftentimes the charity might want somebody to go look at the real estate and actually see what it looks like, what's on it, and what kinds of things they identify in that regard. They might have an environmental assessment done. They would hire an expert to do an environmental report, or perform an environmental examination or inspection of the property. And that's important, I guess, probably primarily from a charity standpoint, because not only current owners, but past owners of the real estate, and really anyone in the chain of title, can be potentially liable for environmental contamination issues. So that's important to know. Oftentimes they might want to do a title search, and that would be the process of determining good title or the accurate ownership information for the real estate. That would be important when somebody's taking title, and that could identify mortgage issues, liens on the property, debt associated with it, all of those kinds of things. And those are all important to know, especially from a debt standpoint. I think debt can be problematic for both sides, both the donor and the charity in contributions of real estate. So generally they'd like to avoid that, and that's something that they would look at too. And then really lastly, as a part of that process, in the end, once the transaction is completed, The charities got to provide certain tax reporting information to the donor, so they need to gather all of the information they need for that. They've got to provide a description of the property and whether any goods or services were exchanged for the property, and if so, what those goods and services were worth. So there's a process involved in donating real estate that might be a little more involved than some other kinds of assets. So that involves additional steps, and organizations like Akron Community Foundation, as I mentioned, certain organizations have experience with that, and Akron Community Foundation does. And they also have a process in place whereby they often use a separate LLC to own the real estate. So you would contribute the real estate to an LLC, limited liability company owned by Akron Community Foundation, and that helps mitigate some of these risks and makes it more attractive.
Okay, thanks, Steve. Mike, Steve and I kind of fumbled on that question about Evan Costello, so let me ask you, what was the name of the player on second base?
What? Could you repeat that, please?
All right, I'll forget that. We talked about real estate, retirement assets, stock, and securities. The last category I was going to mention was life insurance. There's some $10 trillion of that out there. How does a donor make a gift of life insurance to charity, Mike?
So let's think about the title on the screen. It says giving your way today and tomorrow. We'll talk about today as opposed to tomorrow, because tomorrow is name the charity as the beneficiary on your life insurance policy, and that's pretty simple, but that's tomorrow. Let's talk about today, donating a policy today. And before we drill into it, think of who are the parties to the life insurance contract. There's the owner of the policy, the insured, as well as the beneficiary. And the owner and the insured are commonly one and the same person, but not all the time. And so the owner has to convey the policy, all right and title to that policy, to the charity. And how do you do that? You fill out a form. The insurance company will provide a transfer of ownership form. The form gets completed. It gets submitted to the life insurance company. They endorse it. The actual paper policy itself goes to the charity. The charity signs a receipt. There'll be a little more administration that we'll talk about in a minute, but it's a simple process. It's filling out a form, and that's it.
Can a donor claim an income tax charitable contribution deduction, and is there an administration associated with that?
Now comes the complexity. And Steve alluded to that with respect to the real estate and the appraisals. And so I'm going to introduce a term that the appraisal of the life insurance policy needs to be a qualified appraisal, as would the appraisal of real estate. It would need to be a qualified appraisal. And let's just contrast that with Naomi's conversation about contributions of securities or retirement plan assets. Publicly traded securities don't need an appraisal to determine their value, whereas real estate or life insurance policies, we need a qualified appraisal that comes from a qualified appraiser. So what is a qualified appraisal? What's a qualified appraiser? And again, whether it applies to the life insurance policy or to real estate or other assets, it's an appraisal that is made, signed, and dated by a qualified appraiser, who is somebody who is applying the rules and regulations as defined by the uniform standards of professional appraisal practice. And these standards have been created by the Appraisal Standards Board of the Appraisal Foundation. Something to remember about when this appraisal may be made. If you're planning to do this contribution and you want to claim a deduction, you cannot claim a deduction using an appraisal that is more than 6 months prior, 60 days prior to the date of the contribution. So you cannot use an appraisal that might be only 3 months old prior to the date of the contribution of the asset to charity. So keep that one in mind. The qualified appraiser must be an individual with verified education and experience in valuing, again, whether it's real estate policies, whether it's life insurance policies or real estate, that they have to have experience and education in the field. And you need to have this appraisal in hand if you don't do it before. You need to have it in hand prior to the filing of a tax return where you claim the deduction. So if somebody files their tax return by April 15th, they want to claim a deduction for a donation of property and has not been appraised, the IRS and the courts have just slashed that deduction off the tax return.
That sounds pretty expensive, Mike, is it?
As relates to the appraisal of a life insurance policy, no. Actually, we've worked with clients where the cost of the appraisal is $500 or less.
Any additional I's to dot or T's to cross?
Sure. So there's IRS form number 8283 that must be signed by the donee charitable organization as well as the appraiser. And this is a tax form that gets attached to the donor's individual income tax return. Again, if you're filing by April 15th, it's just part of your tax return, but you need to have all these parties sign the form to tell the IRS this happened.
Okay, thanks, Mike. Naomi, you talked in your first part of your remarks about gifts of retirement assets. What about gifts of stocks and securities? Are those items that one can obtain tax benefits from donating to charity?
Yeah, appreciated assets like stocks and bonds are excellent options for charitable contributions because you don't have to recognize the gain when you contribute them. Appreciated assets are just assets that have grown in value since you purchased them.
Would it be better to give an appreciated asset to charity before you sell it, or is it better to sell it and get the proceeds?
Well, let's look at an example on the screen. It might be better to see the numbers in front of us. Thank you. So if I purchased 1,000 shares of Cisco stock in 1991, I'd have paid $305 for it. That same 1,000 shares of Cisco stock today would be valued at a little over $21,000. So I have an unrealized gain of $21,000. The tax using a 23%, which is the highest federal capital gain rate, including the Medicare surtax at 23.8%, would be almost $5,000 of federal income tax. So if I contribute the stock to Akron Community Foundation or a charitable organization, I get a charitable deduction of $21,000, and I don't have to pay the $5,000 of federal income tax on the gain. If instead I sell the stock and pay $5,000 to the IRS, I only have $16,000 to contribute to the charity and have a $16,000 charitable deduction. Here we've only dealt with the federal tax implications. There may also be state tax implications to consider here. The process for donating appreciated stock or mutual funds to Akron Community Foundation is almost as easy as dropping a check in the mail. They have developed an efficient and timely transfer process with First Merit, their custodian bank. They can value and acknowledge their stock contribution according to the IRS guidelines in a very timely manner, and do this normally within 24 hours of receiving the stock.
If a donor wants to give stocks and securities to, say, a donor advised fund, and the donor is pleased with his investment advisor, so who would be in this room, is it possible for them to continue to work with the investment advisor after the gift has been made to the Akron Community Foundation?
At the Akron Community Foundation, that would be possible, and a lot of the other charities that you would donate to, that probably would not be possible. The Akron Community Foundation does permit the current investment advisor to stay on and manage the assets, and not all charities have that option. The investment advisor, they've worked with you for years, and this allows them to continue looking after your investment for many more years. An outside investment manager arrangement can be made for gifts of $250,000 or more to Akron Community Foundation. The wealth manager must have board approval, and they have to follow ACF's approved asset allocation policy. Akron Community Foundation supports the relationship that you have with your advisors, and they want to help them continue to keep helping you. After all, there's great loyalty there, and they have helped you gain the security and accumulate your wealth. And if you want to know more about the investment manager policy, you can contact Laura Fink at ACF. The Akron Community Foundation does have outstanding return on investment year over year.
Now, Steve, Naomi's pointed out how simple it is to give stocks or securities to ACF. What can you tell us about the methods of giving real estate to charity in general and ACF in particular?
Well, as you heard a few minutes ago from me, the real estate does have some unique aspects and some unique problems, but there are methods of giving real estate that are similar to those that you would use for other assets, but maybe a little bit tailored to real estate specifically. And obviously, like in cases of other assets too, just an outright gift of the real estate that's not encumbered by debt is the simplest way to go, but that's not always possible. So in some cases, donors want to make a contribution of real estate to a charity, but they don't necessarily want to give all of the value of the real estate to the charity. They sort of want something back in the form of cash. So they could do what's called a bargain sale of the real estate to a charity, and that's when a donor would sell the real estate to the charity for something less than what its actual fair market value would be. And the donor would get a charitable deduction for the difference between the fair market value and what it sold the real estate to the charity for, and would only pay capital gains tax on the portion that was the sale portion, not the portion that was the donation. So that's kind of a hybrid method that sometimes appeals to donors and to charities. Sometimes, as I mentioned before, the donor lives in the real estate, so it's their residence, and they want to make a contribution to charity, but they still need some place to live, so they can give the real estate to the charity while reserving a life estate, and the value of their charitable deduction in that case is calculated based on their life expectancy and interest rates and various other factors, but it is something less than the fair market value of the real estate, but it's the remainder value that ends up being transferred to the charity. So that's another method that sometimes applies specifically to real estate. And then a charitable remainder trust is occasionally used and sometimes works well with real estate. And that's a good vehicle for people who want to make a charitable contribution, but they also want to retain some income. They also want to avoid capital gains taxes. So you can contribute real estate to the trustee of a charitable remainder trust, retain a cash flow stream from the trust for either your lifetime or a period of years, and then at the end of that term, the real estate goes to the charity. And in that case, too, the value of the income tax charitable deduction to the donor is calculated based on the remainder value and the term of years or the life expectancy and interest rates and so on. But those kinds of things are ways that people who own real estate can make a gift to charity and still cover their needs of place to live or income streams or whatever.
Okay, Steve, let me pose the same question to you that I did to Naomi. Is it make sense to gift real estate prior to a sale, or is you better off selling it and donating the proceeds?
Well, like Naomi, I have a slide that will show us that. And it's actually very similar to her slide now that I've seen what she put up there. But I've kind of compared both scenarios there, and I can't see it, but I've got it printed out here. So in my example, you've got a vacation property worth $1 million. It's got a tax basis of $100,000, and there's no debt on the property. So if the real estate were to be sold, you've got a value at $1 million, basis in the property of $100,000. That leaves long-term capital gains of $900,000. And on that capital gain, you would pay approximately $214,000 in income taxes, and that's assuming a 20% capital gains tax rate and a 3.8 Medicaid surcharge or surtax rate, and that doesn't even include any state or local taxes. So that's the probably the minimum tax you would pay on that transaction. So that leaves you with a gift to charity and a corresponding charitable deduction of $785,800. So you've saved, in that scenario, $96,977 by donating the proceeds of the sale to charity. If, on the other hand, you directly contributed the real estate to charity, again, that's a $1 million value on the real estate, the basis doesn't factor into that equation because there is no capital gain issue. You have no tax paid at all. You would have a $1 million gift to charity, you'd have a $1 million charitable income tax deduction, and that would save the donor $396,000 based on a 39.6 income tax rate. So in that example, it is certainly better to contribute the real estate to charity rather than selling it first and contributing the proceeds to charity. Now that doesn't mean that in every case that is the right answer. There are other factors that might come into play, and again, real estate is unique and has lots of unique issues to it for donors. But in many cases, it is much better to donate the property rather than the proceeds of the sale.
Okay, Steve, thank you. Mike, we've had slide presentations here from both Naomi and Steve, and I know that you're a numbers guy, so would you have a slide you'd want to share with us to demonstrate something?
I don't know. Who's on third?
We'll get there.
No, we do have a slide.
Who's on first?
Laura's going to get it there for us. And talking about the charitable contribution deduction associated with the gift of a permanent life insurance policy, it's a little bit trickier than just the fair market value of the property. And the reason is life insurance policies may have value in excess of the amount of basis, in excess of the investment in the contract, as will securities, as will real estate. But some of that inherent gain inside that life insurance policy would be ordinary income as opposed to capital gains if that policy were sold. So we're going to look at some numbers on the slide associated with, if you were going to sell it or if you were going to surrender it back to the insurance company. So let's assume for discussion here that the qualified appraiser has determined that the value of the life insurance policy is $80,000. And that's gently higher than the actual cash surrender value of the policy at $78,000. So just to distinguish, if the owner of the policy wanted to surrender it back to the carrier, they would get $78,000. And if they did surrender it back to the carrier for the cash, and they had paid in $64,000 in premiums over the life of the contract, that would result in, well, let me contrast the 78 and the 64 for a moment as a $14,000 net gain. You see the $14,000 near the bottom? That would be the ordinary gain from surrendering the policy back to the carrier. You would pay tax at ordinary rates, not capital gain rates, on that $14,000. So back up the slide to the premiums paid of 64. We all know there are some charges inside life insurance policies, one of which is called cost of insurance. So for this illustration, assume there's $10,000 of insurance charges, cost of insurance charges, which reduces the investment in the contract from 64 down to 54,000. That's the basis. So if the policy were actually sold for its value of 80,000 and the basis is 54,000, that would result in a gain of $26,000 for tax purposes, some of which is taxed at ordinary tax rates, some of which is taxed at capital gains tax rates. We already talked about 14 being the amount subject to tax at the ordinary rates, leaving 12 subject to capital gains tax rates. And what the IRS doesn't want us to do is gain a tax deduction for property whose value is attributable to ordinary income. So inside that $78,000 value, that $80,000 value is $14,000 of what would be referred to as ordinary gain as opposed to capital. So the deduction in this fact pattern is limited to a combination of the basis, 54, plus the capital gain component of 12, or 66,000.
Okay, thanks, Mike. We've had some pretty technical discussion here, a lot of number crunching, so to lighten the mood a little bit, we have a program coming up here on charitable giving for children that Margaret was talking about at the end of our remarks. But Naomi, can you share a story with us of a family that you've worked with that have used experience to encourage gifting by the next generation?
Yes, thanks, Rob. I'd love to. As you know, the charitable generation, the parent generation, for instance, may not always naturally pass down to the next generation, the children or the grandchildren. If parents want to encourage their charitable giving and continue the family legacy, they have to experience, let me start over. Parents want to encourage charitable giving and continue the family legacy. And I have experienced this many times in my business and with my clients. So for instance, the parent sells their business. They take a large amount from that proceeds and they fund a donor advised fund or an endowment fund so that they can continue making charitable contribution or donations for many years. Initially, my client gave their children and their grandchildren the gift of matching all contributions that they made themselves to charity. This was a really nice opportunity for them. It encouraged them for giving, and it also, with the matching, made the gifts more impactful. Later, the parents split their fund into 3 shares. 1 share that they kept for themselves, and then 1 share they gave to each of their adult children. Now the adult child has a fund of his own so that he can continue giving charitable contributions out for the rest of his life. And he has a fund that he can make contributions into. The goal was to teach philanthropic children, and it did instill that in this family. They also had family meetings around charitable giving and what to do with the fund over many years. I would say the family accomplished their goal, and the community benefited for many years by their charitable giving. In fact, Akron Community Foundation is bringing in the author of Raising Charitable Children to speak to the attendees on June 11th from 5 to 7 at the Firestone Country Club. This event is sure to help you be creative and successful in raising your children to be charitable and to continue the legacy and start giving of their own.
Thanks, Naomi. Inspiring story. Steve, do you have a story of a family that used a charitable donation of real estate to achieve their goals?
Well, I don't necessarily have a specific one, but I've got lots of clients who have vacation property. Many of my clients, when it starts to get cold here in Northeast Ohio, head somewhere warmer. In fact, most of them probably pack up and head to Florida for the winter time. And as they get older and as their interests change and as their ability to travel sometimes changes, they spend less and less time in what once was a vacation home that they frequently used. So as they spend less time there, they see less benefit from all of the money and the effort they put into maintaining that property. They still have to pay the real estate taxes, they still have to maintain the property, they still have to do all of what they would have done if they were using it a lot, but they don't see much benefit from that. So they have a few options, I guess. One, they could rent the property themselves, lease it to other people, and that could create an income stream, but that often requires a lot of effort and can be very stressful, so that doesn't appeal to many of my clients. They could sell the property, which again would stop the bleeding, so to speak, on a lot of the financial drain that they might be experiencing, but that too takes some effort and can be stressful and burdensome. So many times they look to situations like we've discussed here where they might donate it to charity, and that will get them the income tax deduction we talked about. It will stop the expenditure of the cash to maintain the property, and it relieves them from some of those other things. They don't have to sell the property themselves. They don't have to deal with tenants and management of the real estate. So it becomes appealing when those circumstances exist. So I have seen many people with vacation homes who look to those as assets to donate to charity.
Okay, thanks, Steve. And Mike, with a gift of life insurance, typically, except for single premium policies, you're going to have an ongoing premium obligation. How is that going to be handled when you're made a gift to charity?
So, as a practical reality, the donee charitable organization wants the donor of the policy to commit to continue to pay the premiums going forward. Now, when we say that, we don't really mean that the donor is going to write a check to the insurance company, rather write the annual check to the charity in the amount of the premium. Of course, the charity will deposit it and use that money to make the premium payment themselves. The donor gets a charitable contribution deduction, charity makes the premium payment, and the policy should stay in force.
What if the life insurance policy is encumbered by a policy loan that the donor incurred prior to the gift?
So that, of course, another complicated situation. And if a policy is encumbered by a loan and the policy is donated to charity, here's how the IRS looks at it. Since the donor had an obligation or a loan to repay before the donation of the policy, and then after the donation he no longer has that loan to repay, then the donor is considered to have income from the forgiveness of indebtedness. Again, as a practical matter, ACF and most charities really don't want to accept policies that are subject to a loan anyway, so you really got to handle it, take care of it before the donation.
You know, Mike, I've heard terms bounced around for many different types of insurance policies: term, whole life, universal, variable. What are the different types of insurance, and how does that affect their suitability for gifting?
So Rob just mentioned term, whole life, universal, variable. He used 4 different terms. Not the right word to say. There's term insurance and there's permanent insurance. Whether it's whole life, universal life, variable, those all fit into the category of permanent, perm or term. So the term policies are commonly used for income protection in a family setting. You make an annual premium payment, whether it's for 20 years or 30 years, and at the end of the period, usually the premiums skyrocket, so most people just let those policies lapse. Not the best type of policy to donate to charity. Rather, it's the permanent policies, whether whole life, whether it's universal life, whether it's a current assumption, an indexed product, a variable product. All of these permanent policies are designed, I should say most of them, not all of them, are designed to have a cash value associated with them. And to the extent that the policies have a meaningful amount of cash inside those policies, then the donor should get a meaningful charitable contribution deduction, and the charity may have enough funds inside that policy to continue to pay its premiums going forward. So it's more common to see permanent life insurance policies donated to charity as compared to the term policies.
Mike, you've talked about an insured giving a policy. Is it possible for an insured to purchase a policy on his life in the charity's name at the outset?
It's not real common, but charities can be the applicant for a life insurance policy and subsequently the owner of a policy on an insured. So if I wanted the Akron Community Foundation to own a life insurance policy on my life that I don't have to donate today, but rather I commit to the Community Foundation, I will pay X every year, whatever that premium amount is, to generate Y amount of death benefit. Under the Ohio Revised Code, the charity is deemed to have an insurable interest in me. So that can happen.
Steve, you talked about environmental assessments, title insurance policy, qualified appraisal. All those things involve costs. How are those things handled with a gift to charity?
In most cases, the donor is expected or required to pay the costs. And I haven't specifically talked with the people here from Akron Community Foundation about those kinds of things, but it's my understanding that even with Akron Community Foundation, the general rule is that the donor pays the cost of those things, but there may be some flexibility in working through the process with the foundation and maybe minimizing or allocating some of those expenses.
Okay, we're going to open up questions to the floor for a moment, see if anybody else has any questions. But, this is an expert panel. They know the answer to every possible question. So let me ask you one possible question that we haven't rehearsed. What is the name of the third baseman?
I don't know, Rob.
I thought you knew everything, Mike.
It's one on every panel.
Yes, question.
What if the real estate is held in an LLC, like most commercial real estate is?
The question was, what's if the real estate is held in LLC?
Well, I suspect, I've not personally dealt with that before, but I suspect you contribute the membership interests in the LLC to the charity, and then the charity could then deal with the real estate either through the LLC or liquidate the LLC and take the real estate out, something like that. I'm sure it can be done.
Apparently, if it's a single member LLC, then the transaction is disregarded for tax purposes and in fact would be beneficial because of the limited liability associated with the LLC.
Right.
Other questions? Leo?
On the charitable remainder trust, that can also be set up for someone if they want to put stocks or whatever into that also, right? So if you
Absolutely.
had somebody that wanted income to help support them and they wanted to put money into a charitable remainder trust, that's something that's.
Yeah, Leo's question
Absolutely.
was, can the charitable remainder trust, which Steve mentioned in the context of real estate, also be used with stocks and bonds?
Yes, and oftentimes that's even better because there are distribution requirements from the charitable remainder trust that sometimes can't be fulfilled with an illiquid asset like real estate, but with stocks or bonds or other things that generate income, that would even be more appropriate sometimes.
I want to add, in our November presentation, we'll be drilling down deep, and that will be one of the subjects for that presentation.
Okay, I hesitate to recognize Steve Schechter because the guy's got a better sense of humor in the crowd. I know it is. Steve?
Oh, I love it when you say that, Rob. I want to ask something really funny. This is a real knee slapper. Steve, you talked about the fact that real property could be donated to charity, and the donor, if they're an occupant of the property, can retain a life estate to live there. What if the property is income producing? Can the owner donate the property now, take a deduction to some extent, and still enjoy the income somehow? Now, was that a laugh riot or what?
Yeah, I'm trying to control myself.
I would have found it a lot funnier if you would have asked someone else the question. But since you asked me, I've never dealt with it. I've never done it, and I'm trying to think through all the problems that might come from that. I'm going to get back to you, Steve. You're absolutely right. But I don't know. I mean, I think there could be some creative ways to do that. Yeah. There's a lot of issues that have to be worked out. Mike,
It sounds
would you
like
jump
the
in there?
donor has a retained interest in the property.
Right.
Which would
Not yet.
significantly reduce the value
Yeah, and
as appraised.
Well, right, and I guess maybe the donor could retain a life estate in the property, which, similar to the right to live there, you would retain the right to the income from it, rather than just the right to live in it. So I think you could do it.
Okay.
Other questions? Yes, sir.
I have a question for Steve and then one for Naomi. Steve, in your example, you had a $100,000 basis in the $1 million property.
Correct.
And did I understand you correctly that if you did a bargain sale, you could do a bargain sale of $100,000 and then actually receive $100,000 tax-free out of that and then donate the other $900,000?
Well, I'm not sure if I'm following the numbers, but I guess if you, let me see if I can think that through. So if you had a property worth $1 million and you sold it to the
Your
charity.
basis was $100,000.
I think you
Right,
got-
you have to allocate the
You have to
basis.
prorate the basis.
Yeah, you have to allocate the basis between the sale part and the donation part. And it's allocated on a pro rata basis, so you wouldn't benefit that way from it.
Yeah, but it'll be a
Some benefit.
It would be some benefit, but
Yeah.
not a full recapture basis, right?
Correct.
Other questions? Yes. Oh, I'm sorry, you have one for Naomi, I'm sorry.
For Naomi, this was a stock option question. So if you had options that were appreciated and a nominal value in the options, how would that work in terms of a donation and how that would calculate back both to the donor and to the benefit of the foundation?
Well, that's a hard one. Initially, my answer seems to want to be, it really depends on the option, because the options often have so many restrictions in them, whether or not you can give them or not. So you would have to look further into it, but I would think that the option, valuing the option would be difficult because of the other parameters in there. But I would imagine there would be a way to make it happen. I'm not sure exactly how beneficial it would be as far as the fair market value of it.
There's a lot of vagaries there. Are the options compensatory or non-compensatory? Alternative minimum tax, a lot of issues associated with that. Other questions? Well, if not, what about thanking our wonderful panel for the investment they put into